trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good morning, Market Rebels. And actually, Stu, I'm not so sure what's good about it. We're doing this pre-market here. Normally we do it live at 4, but because of a lot of things that are going on in the market and some other obligations, we're going to record this one first. So we don't know how the market closed, which is why we're not talking about it. But we do have a pretty good idea of how it's going to open. What are the futures looking like right now, Stu?
The futures are looking down about 1,000 or so points on the Dow.
Yeah. What percent is that?
Uh,
3?
2.7 and 3, somewhere in there.
2.7. So
Yeah.
we know that there's circuit breakers, and they've changed through the years. I believe they're 7, 13, and 20% now.
Yeah, 7% down, 13%. This is on the S&P, 13% down and 20% down.
And then what are the time limits?
15-minute halt on the first two, and then all day on the second.
And then all day on the last one. Yeah.
None of what's going to take place if the drop occurs at 3 after 3:25.
So okay, yeah, going into the close, they just leave it. Yeah.
They're just circuit breakers that were put in place after the I think after the crash of 87.
Yeah. Yeah, they've changed the levels and the timing of them a little bit. But for those who may not know, there was some chatter about that, and we decided it would be kind of really a big down day, but we would have to be down 7%. So we're, depending on which index, we're pushing close to halfway there. But what's going to be interesting to see is how the market responds on the open. Are we going to continue to sink fast, or rebound? Who knows? But at any rate, they are certainly good opportunities for investors, traders, and certainly options traders, because that also is volatility. It's another component that we can trade as an options trader. But what I thought would be a good topic here, because Stu and I get a lot of questions in our Q&A class, and a lot of traders talking about rolling. And even though we're big proponents of rolling and we advocate it, we teach it, we also like to show that there's always another side to the story.
Always. And it's not just this topic, it's all topics.
All topics. And unfortunately, what we hear is too many people say, they talk about rolling as if it's the be-all, end-all. There's no other choice. There's no trade-offs. And we've done this topic before, but because of the recent market conditions, we thought it would be a good one to revisit. And we're going to take it from a little different angle this time. So our Chalk Talk question, since you have kind of an idea of where we're going with this, you've got a $100 option that's appreciating at 10% per year. Now, I want to make this clear. We did this to make the math easy. We're not saying it's a 100 strike. We're saying it's worth $100. So it could be a $100 call with a stock at 200. It's just pure intrinsic value. Otherwise, we have to use a pricing model and take time off the clock, and it just becomes a lot more complicated to get
the concept across. So
Yeah,
just
and that's
understand,
not what we're trying to do, right? We're just trying to let you know that.
to see what the true cost is as opposed to what it is down to the penny. So you could also just think of this as a $100 stock or whatever. That's fine. Now, each year, we're going to roll for a $10 credit.
$10 in your pocket, free
10
money.
bucks in your pocket. There, that's the reason for the question. Everybody goes, my gosh, it's free money. I'm getting paid. It's generating
off.
income. Question is, what's the cost
Lowering
after
my cost basis, all kinds
lowering
of.
my cost basis? I'm going to get up to negative cost basis. But what's the cost? After, let's say, 20 years, and you might say, well, I'm not going to hold an option for 20 years. That's not the point either. You can roll. You can invest for 20 years. And if you're trading weekly options over the course of 20 years, it's the same idea. So again, we're just doing this to make things easy. So we're going to start off with appreciating at 10% per year and pulling out $10. You might look at that and say, hey, wait a minute, 10% of 100 is 10. There's a very good reason why we're starting with this lineup, and we're going to look at some other scenarios as well.
Bill,
So kind of toss.
Bill, let me take 1 second here. You said something really interesting, and I kind of hear this a lot as well. Not that you're going to use an option to invest with for 20 years.
Right.
And Bill said, I forget exactly what he said, but you might have a 1-year option that you're trading with or investing with, 85, 90,000, rolling. And you may renew that every year.
You could be trading 0 DTEs for 20 years.
For 20 years.
Not counting commissions, it's exactly the same idea. Exactly. It would just be a whole lot more complicated. And people would be scratching their heads going, I can't even follow this. We're just trying to get the idea across. And that's why we're trying to really simplify this.
People are, too often just swayed by some expiration date that they happen to pick, which really doesn't mean anything. It just has a different characteristic about the option. But, you can use a 3-year spider option. Do they have 5 years?
They have 5 years on Super Leaps on SPX, yeah.
Super Leaps on the index. Look, you could pick that one and then you could roll that 4 times. And
that'll be 4 times, right?
So
not out of the question.
Don't get wrapped up in this, where, don't get wrapped up in the idea that, well, this doesn't really matter because, I'm trading a 1-year option. It's not the point.
Exactly. So that's the question that we're going to lead off with. And also, quick reminder for everyone, marketrebellion.com/get started for more great information just like this. We have all kinds of articles and videos, absolutely free. I'm only going to put one of these plugs in because we don't have a lot of slides. We're going to spend a lot more time in the Excel spreadsheet. But anyway, some more free information for everyone. So the topic for today, what's the cost of rolling? Now, again, we've done this in a little different format. I think it was the end of last year, but we want to revisit it and we're going to look at it from a little different angle. So the first thing is, let's define what a roll is. Whenever you hear the word roll, we like to tell people it just means switch. You're just going to change out. I have an April option and I want to roll it to May. I want to extend the time. That would be a type of roll. I have the $100 call. I want to switch to the 105 or roll. Now, one of the reasons for probably the most common roll is to roll a call option up or a put option down. And when you roll a call option up, you're generating what, Stu?
Free money.
Free money. Credits, right. We get credits. We know that lower strike calls have to be worth more than higher strikes. So if you give up or sell your 100 call and you buy a 105 call, it puts money in your pocket.
I want to do credits. I want to get paid.
I want to get credits. And this is what we're trying to show people. Not that rolling is bad at all. Again, we teach it. We advocate it. We're just saying that we want people to understand all of the trade-offs to make the best decisions. And it's not just about, how could this be a bad thing? I'm getting cash and I'm reducing the cost basis. There's another cost that everybody seems to overlook. So here's the basic idea for a roll. Let's say we have the 100 call trading for 6. Most of the time, if you are on it for longer terms or deep in the money, we usually tell people to roll when you can capture 80% of the difference in strikes. So if you're going from, let's say, a 100 strike to the 105, that's a $5 difference. 80% is 4. So if you can get a $4 credit for this $5 roll, it's probably a good time to take it. So right now, here,
start thinking about it.
To at least start thinking about it. Now, of
Right.
course, there are always other exceptions. If you're in a weekly option and happen to get a big pop in it, probably not going to get 4 points for it, but you're also probably not going to pay a lot for the option. So we're just trying to say this is a little bit more of a longer term perspective. So graphically, here's our hockey stick for our 100 call. There's our maximum loss of 6. We've got our unlimited gain. What's the break even here? We take the 100 strike plus the $6 cost is 106. We need the stock at 106 at expiration just to get our money back. This is the speed component I was talking about in Vegas recently. So one of the things that everybody tends to gravitate towards with the roll is they'll say, well, if I can get a $4 credit and switch out or roll to the 105 call, I'm going to move from the black line to the red. And the reason for this graphically is that we are lifting up this maximum loss. I can now only lose 2. See, I used to be able to lose 6. I've now pulled a $4 credit into my pocket. And so I've reduced this line by 4. That's why that's -4. And that's a benefit. And that's why I put that in green. This is what everybody sees. I've reduced the amount that I can lose. But here's a cost. Here's one cost that everybody overlooks. You're going to push that break-even point out. Notice this red line for all of these parallel parts is shifted to the right by how much? $1. Why is that? Kind of curious there, Stu. It looks like we got $4 in our pocket, but there's a $1 cost, and those two numbers I can't help notice add up to the difference in strikes. What's going on here?
Well, that's your liability, Bill. That's what you're giving up. You're giving up that dollar in order to get the 4. It's like, hey, buddy, give me a $5 bill. And the guy says, all right, I'll say, give me $6. I'll give you a $5 bill. It's that kind of thing. It's
right.
like,
it's a
you're going
cost.
to get the money in your pocket for sure, but it's going to cost you $1 to get it because the intrinsic value of that difference in strikes is the difference in strikes. It's $5, right? So $5 is $5. And if you're getting 4 for a $5 bill, you're kind of out of $1. Now,
Correct.
again, let's just take a second to reiterate. That doesn't necessarily mean you shouldn't do it.
Correct.
And it doesn't mean that it's, not a benefit. It is costing you. And that's the point of what we're trying to do here. We're trying to point out to you that there is a cost. There's also a benefit. We'll get into that maybe a little later, but there is a cost to it. So go ahead, Bill.
Yep. So if that's for anybody who might be new, you used to have the right to pay 100, let's say for the shares with the 100 call, but now you've switched or rolled to the 105. Now you've got the right to pay 105. So everybody sees the $4 credit, but what happened to your rights? You've kind of dinged yourself by 5 points. You've increased your purchase price by 5 points, but you got $4 in the pocket for it, and therefore you're worse off by $1. Again, it depends on how we're looking at it, but this is a cost, not really the one we're going to be talking about here, but this is one that a lot of people overlook. So now what's our break-even point? Now we have the 105 strike at an effective cost of what? 2. Remember, we paid 6, we collected 4, we have a net $2 into the position. So 105 plus 2 is 107. It used to be 106. This is another way to see that that red line is pushed out now by $1. Stock goes up some more. We switch or we roll from the 105 to the 110 strike. We go from the red line to the blue line. And again, we can see that we have now shifted this up by 8. We've now put $8 in our pocket, assuming we got $4 on each roll. But we've pushed out the black line by $2. And notice that 8 and 2 now add up to the difference. Of our starting strike was 100 and our ending strike is 110.
Right.
So you can see right now that we are giving up some money. But now let's answer another question. What's our break-even point? See, there isn't one because this blue line doesn't cross 0. Remember, 0 means no profits or losses. That's what this vertical scale is. So if that blue line right there is no longer crossing that line, they go, I now have a free option. I'm now playing with house money and I have no cost. Well, again, this is a very easy trap to fall into because if we look over to this side, let's pick a stock price of 120 at expiration. If you were on the blue line with the 110 strike with the stock at 120, that would be worth how much? 10. If we had kept the 105 call instead with the stock at 120, it would be worth 15. And if we had stayed on the black line with a 100 strike with the stock at 120, it would be worth 20. Well, again, there's a very big difference between 20 and 10. You're giving that up. All right, so this is only one, and it's not the one that we're talking about, but we just want to make sure that people understand that rolling is not about the free $8. You have to also consider this money that you're giving up, especially if you're a longer term trader. So now with that, let's bring up our spreadsheet. Where'd we go? Right here. Okay, so now this is a spreadsheet. And what I've done here, Stu, I've put this in red. These are variables. These are things we can change, and we'll do some scenarios here in a minute. I've got years down here, but you could make these days, you could make them weeks or months, whatever unit of time you want to make.
Yes.
I did them as years, again, just to make the calculations easy to follow. Now, we start off with Trader A has $100. You could think of this as $100 in a bank earning 10%, $100 in an option that is appreciating at 10%, whatever suits you. $100 stock, doesn't matter. So this is Trader A, and Trader A every single year picks up by 10%, right? And then he goes to 121, 133, and down here he's worth 672.
Every year he's just making 10% on
the
money.
total balance, right? So we're getting some compounding.
Right? Accumulating.
We are compounding here. Now Trader B is going to withdraw cash.
Mm-hmm.
He's going to roll, and right now we're assuming he's pulling out 0. So Trader B should be identical to Trader A, and we see that he is. So now let's say that he's going to pull out some cash. Maybe he's going to pull out $5. Let's do $4. We'll do like some $4 rolls here.
Okay.
And so what we can see is that now Trader B goes from 100 to 110, just like A, but he pulls $4 out. That's now sitting in cash, so he's got the option is 106. But he's also got $4 in cash, so his total position is 110.
Mm-hmm.
But you can see that in step 2 here, year 2, Trader A is 121. He's 120.6. He's starting to slip a little bit. Why? Because this is not appreciating at this rate. Now, if we wanted to get really technical, we could put a money market rate from your broker. Most of them are pretty close to 0. But technically, that would be earning interest, but it's not going to be nearly the appreciation you're going to be getting on your option.
Bill, what would you say that people are doing with that money? Like, where is it going?
I think initially it goes in money market. For me, what we typically like to teach is keep it there when markets do stuff like they're doing today, and now you've got cash for a good buying opportunity. What most people do is they say, I've got to put it to work, and I've got to go buy something else. So it depends on the trader. I like to keep it as cash.
It may not work. That's right. And some people take the money and they, withdraw it and they spend it.
They might spend it, right? Use a car payment
like
or
you
something.
Said, if it's sitting in their money market account, they're probably not getting real money market rates.
Sure.
Where I'm going with this question is, it's not most of the time, or a lot of the times, it's not compounding. That's
exactly. That's what we're just trying to do. To make it simple, we're going to pull it out of the equation.
It's not part of the equation anymore. Yeah.
Yep. The point to see is that down here at the very bottom, after 28 years, now that's only a small part of the portfolio, mind you.
20 years.
I'm sorry, 20 years. That's 28.5%. That's the difference between that number and that number. This number is 28% bigger than this number. Of course, we can do the.
What are you saying here, Bill? That like you're kind of out 28%?
You're out 28.5, almost 29%.
Because you rolled and and paid yourself credit money. Correct.
That's the thing that people don't see, is that we've all heard the analogy of a snowball rolling down the hill, right? And the bigger the hill, the bigger the snowball gets, the bigger it gets, the faster it rolls, and the bigger it gets. That's compounding. But when you start pulling money out, what you're doing is you're busting up your snowball and starting halfway down the hill. And then you're busting it up again and starting down the hill and trying to get it to compound. The real magic of compounding is at the end. You can see there's not a very big difference through here, but starts to show up down here. So this is where, if you're using options for long term, and especially if you have significant money in them, such as with stock replacement, you need to consider this. It adds up over time. Now let's do something a little more interesting. Let's pull out $5. Look at that, 38% difference. But now let's go up to 10, which was our question. And what's interesting about this? Notice that this line went straight. Okay, let's go back to 5. Notice that red line is curved. There's still some compounding in there because we haven't completely bailed on it. But when I
Are
go
we
to 10,
eating into principle here, Bill?
well,
point?
not quite into principle because we still have it down here. But what are we doing? Here's what's interesting. We've actually, if you notice this total over here, it goes from 100, 110, 120, 130. We're just counting by tens. This is actually simple interest. Now, you don't see that too much these days, but if you deposited $100 into a bank at simple interest, the banker is going to say, we're going to pay you, in this case, 10% on that initial deposit, which is $10 per year. If you decide to leave it in the bank, that's your business. But we're only paying you on that initial deposit. So you're only going to earn a fixed $10. Notice over here, that's not true. You're earning 10, here you earn $10 or 10% on the 100, but now you earn 10% on 110. See, compounding is allowing you to earn interest on interest. So what you've done, if you have this option, let's say that's appreciating at 10%, and you pull out that interest, or whatever that annualized number is, you could do it every $5 every 6 months, whatever, however you want to look at it, you're actually converting the compounding to simple interest. And that is a huge cost. Look at this, 124%. That's 2.24 to almost 2.25 times bigger. Got 672 versus 300.
And you can kind of apply this idea. I think you can apply this idea to like maybe a fee that you're paying.
Oh, absolutely, you could. Sure,
money manager.
Exactly.
Or, what do you call those fees? I forget the name of them. Like, all of the ETFs have them. The management fee. What's that called?
Yeah, just like operating expense ratios.
Yeah, operating expense ratio.
OERs.
Yeah. They have this. They eat into it. Doesn't look like a lot. Half of 1%, 1%, 1.25% looks like nothing, right? But this is the compounding effect. It really adds up.
And you can see how the difference between the blue and the red line out here are much, much greater out here on the right side than down here. Again, that's the idea of compounding. It really shows up in the end. But now let's do something even more interesting. Let's say that you're compounding at 30%, right? We hear options traders say, oh, I'm making 200 and 300% on my options.
Yeah.
All right. Well, now let's say that we'll go back to pulling out $4 credits. Now we can see it's not going to make that big of a difference. Why?
But you're getting more, think about it, everyone, right? You're getting more money on what money that's working.
Exactly. You've got more money to compound, and it's also a much bigger compounding force. So as we make this number bigger, if you were compounding out at 100%, wouldn't that be nice? This $4 is effectively becoming zero. It's just because you can see that these two lines are now virtually identical. But let's go back to 30%. But what if you pulled out and you say, gosh, I'm compounding so much. Let me pull out $20. That's 180% difference. That's 19,000 here versus about 6,800 over here.
It's really interesting. Look at the trade-off. Yeah, I'm going to get the money, but now that's
the money today. But
compounding.
Exactly,
and it's like giant percent, which is really unrealistic as well. However, just for the example,
it's just
it's this side and it's this side. It's not just the one side.
Right, and that's really all we're trying to show is that people to understand that if you are going to take a long-term perspective, and if you have, I'm not talking about $100 in an option on $1 million portfolio, might as well not even count that. But if you've got significant, especially with stock replacement options, and you've got some real money into these options, and remember, they're behaving about like shares of stock. Over time, that compounding can really get crushed by taking these credits. And again, we hear people talk about it as if there's no trade-off. Oh, I keep rolling this stuff. I'm getting all my credits. I've got a negative cost basis. And they're never saying, what's the trade-off? And so the main point to remember is that there is always a trade-off. And that's what you need to identify. If you can't identify the pros and cons of a roll or of strategy A versus strategy B, you need to reconsider, because you might actually change your mind once you see the full picture.
Yeah, you have no business being in it. If you can't figure out both sides of it, then you can't make an educated decision. Now, look, on a day like this, as I said, as Bill said, we are pre-recording this, but we know the market is going to open down. You know, rolling throughout the previous few years, you know, you might feel pretty good that you rolled on a day like this.
Yeah, getting ready to cash in now.
Taking that strike price from 100 to, you know, make a number up 250 or 300, and all that intrinsic value came off the table, and now it's sitting safe down in your pocket. Maybe, you know, unless you put it into Apple, which is getting killed today as well. Yeah. But, you know, whatever the case is, there are trade-offs. Again, you know, it goes both ways. Yeah, you're not compounding. You are getting maybe a benefit if the stock happens to crash. And that is a benefit, right? And that's the synthetic side of the equation. That's the synthetic put. So you have to understand that as well, right? There's a bunch of different angles going on here. Our goal is to get you to see the big picture to be able to make a better decision.
Right. And you also bring up a good point. When you get days like this, if you are in it for the long term and you've been rolling, you kind of bank that cash over here. What's the thing that you have to do on a day like this? You need to start putting that cash back to work. And what do people do?
Back to work.
Oh, let me start selling everything. You're like, this is not the goal. This is not the reason for doing the rolls.
Get me out.
Right. Yeah. Get me out. Let me go buy some puts. No, you got to go start accumulating those assets that you now have given up back here. That was part of the long-term plan. So that's where it could and most likely will benefit you if you are rolling with the condition that you will put it back in when there are good opportunities, not let me just switch. Just because people feel like it's better because I sold something at a gain and I'll go put it into stock B or stock C. And that's just mathematically makes no sense. There's no reason to change a winning strategy. Or at least that doesn't give you a better percentage on the next one. And that's what people think. I'm going to get out at a gain and I'll go move to something else. That's not going to, if that were the way to improve your odds, buy, sell as fast as you can until you can get it to 100% chance by switching, right? That's just not going to make any sense. So anyway, that's what we wanted to show people. And I think we've got a Chalk Talk question here. So let's go back and revisit this, Stu. A $100 option is appreciating at 10% per year. We are pulling off $10 credits each year. The key here is that we are removing the interest earned, so to speak. So what's the cost of compounding on that? One of the answers that I was looking at is not so much the exact answer, but that you're switching from compounding to simple interest or simple compounding. And that is a massive difference.
Really interesting. Really interesting.
Yeah. Yeah. So I think that's, you know, we'll have to see what time is it right now? About 5 after. So we got about a little less than a half an hour till opening. Looks like, what are the futures right now? Still about 3% down?
Yeah, getting a little worse. We're
okay, heading worse.
Little bit.
Yeah, so there's a good chance we're going to see it slip on the opening bell. The thing that's going to be most interesting to me, are we going to end up on that Maribozu red candle closing at the low? Or are we going to hit a low and see a big rally intraday or something in between? So that'll give us some talking points for next week. But until then, understand your options, and that's what's going to allow you to stay safe and to capitalize on moments like these.
Cooler heads prevail. Just remember that. Cooler heads prevail.
Yes, exactly. These happen all the time. If you've never seen this before, you've not been investing long enough, these happen all the time. They're opportunities if you remain calm. This is why we get the returns that we do in the markets, not the T-bill rates. So anyway, there'll be some good talking points. I know we've got a Q&A today at noon, so we'll have a live market, then we'll come back and revisit that. But for everybody else, we wanted to at least throw this out there to give you some more information to help you make better decisions. And that's what Coach's Corner is all about. So we appreciate you joining us, and we'll see you next week.
Yeah.